The housing sector has been one of the areas that's shown real strength during the coronavirus pandemic and the recession here. We had housing starts surge 22.6% in the month of July. Also, mortgage delinquencies have moderated after hitting a 9-year high in the second quarter. Here to discuss real estate and housing is DoubleLine Capital Portfolio Manager Ken Shinoda. Ken, thank you so much for joining us and welcome to Yahoo Finance.
Julia, thanks for having me.
All right, Ken, I read a note that you put out on just the state of the housing sector and really interesting comparisons, because I think a lot of folks kind of heading into this were initially really nervous, kind of going back to the global financial crisis and thinking we might see something similar, yet certainly not the case. Walk us through what's been going on in the housing sector. What are you seeing specifically that's maybe a lot different from years past?
Yeah, I mean, let's think about how we entered the March timeframe coming into COVID. Very different from how we entered the last financial crisis. You had very low inventory of homes available for sale. In fact, we went into COVID with 35-year lows of inventory of available homes for sale, about 1.5 million homes. You finally had new homes being built reach about 1.5 million too. So that's a pretty low level of supply. If we think about what drives home prices, it's a combination of this supply demand that I'm starting to talk about, and then affordability. So going into COVID, supply was very low, and you actually had demand picking up. You had demand picking up because of the second largest generation since the baby boomers, the millennials, and they've been saving up some money. They're starting to have kids. They're going to want a house. Being in a one-bedroom apartment in Manhattan doesn't sound so good when you've got 2 little kids. So that migration had already started, and you could actually see data showing that urban areas seeing less population growth, suburban areas seeing a higher population growth. So supply demand was positive. You had home ownership increasing back towards the long run, 65%, now higher than that. And then affordability, right? Affordability is driven by 2 things, really. It's income, which had been rising, and then interest rates, which drive mortgage rates, and those are at historic lows. So going into COVID, things that looked pretty good. Now, what happened after COVID? Well, clearly the concern was we're going to see a spike in unemployment. We saw unemployment spike north of 14% in April. But what you see is that a lot of the job losses have unfortunately hit the lower end. So these are hourly wage workers. They're in industries like hospitality, the restaurant industry, leisure. And most homeowners are white-collar employees. They have higher-paying jobs. They needed higher-paying jobs to have down payments for homes. So thus far, they haven't been hit as hard.
Well, several things that we'll want to dig in there. Of course, I'm one of those millennials. I'm in my early 30s. I'm in New York City right now. And I'm telling you, the suburbs are looking pretty attractive these days, something I never thought I would honestly say. So what happens to more of these urban areas, the city centers? What are some of the implications here? I guess, how do they kind of transform over the years? What do you think ultimately plays out?
Yeah, I mean, this is a good question, and it's a question you have to ask yourself when you're analyzing the commercial real estate market as well, which I think we'll probably talk about a little bit later. And there's 2 things you have to think about. In the short run, there's this knee-jerk reaction of let's flee these urban areas. But in the long run, one has to believe that humans are social beings, and we want to come back to city centers, and we want to go back to the office. I think even in the heart of the work from home, probably in April and May, there's some studies that got done about, they surveyed employees and how many people want to go back to the office. And back then it was about 65% of employees wanted to go back to the office. And it kind of makes sense. I mean, we're here month 5, month 6 at DoubleLine, and we get by. We're very efficient using Teams and Zoom and things like that, but nothing can replace that human interaction. So I think in the short run, you're definitely seeing people realize, if I'm going to work from home, I need more space. There's a lot of anecdotal stories about the flight to the suburbs. It's very hard to actually get data to prove it. The Census Bureau doesn't separate suburban. It's just either urban or non-urban. But you do hear anecdotal stories like yourself. And I think you're seeing a lot of that happen as you see real estate prices actually increase, contrary to what people would have expected going into this economic shock.
I also want to dig in with you. I know you mentioned that most homeowners are probably not likely to be, they're not, more of the hourly wage workers who got hit the hardest by the crisis, more, the typical, or most likely to be a homeowner rather. But, Jeffrey Gundlach, CEO of DoubleLine, has talked about maybe a possible impending white collar wave of job losses on the horizon. This is something I talked to economist Nouriel Roubini about. How do you kind of think about those as possible risks? And I don't know what kind of reaction there would be to kind of stem any of that, a la something like the CARES Act, if you will.
Yeah, I mean, look, that's there's a couple things, including that. Also, you've got the unemployment benefits that rolled off that maybe had been helping some of the strength we've seen in the broader economy, not just people's ability to pay mortgages and pay their rent. So we have to see, in the long run, what are the after effects of COVID? And, we have to assume that, eventually we get a vaccine or something that gets us back to being a normal life. But people have changed their behaviors. Both consumers have changed and businesses have changed. Any change that was already occurring, like the shift from going to the mall to buy something to buying it online, all those things have sped up because of COVID. So, the white collar job losses could come if we continue to see economic malaise out there. But one thing that the housing market has going for it is that, the FHFA, which governs over Fannie and Freddie, has been pretty aggressive with something called forbearance. So if you're a borrower and you are having some trouble with your job because of COVID, you can call your mortgage servicer and you can tell them, hey, I'm having issues paying my mortgage, and you can now miss up to 12 payments, and your FICO score doesn't get hit, and the servicer can actually, if you're a Fannie Freddie loan, move those missed payments to the back of your loan, non-interest bearing as a balloon. So this kind of gives homeowners 12 months to allow the economy to heal, to allow for them to go find another job. And I think this is something that we didn't have during the global financial crisis. There was forbearance, but not to the large scale that we put into place, with the help of the Fannie, Freddie, and Ginnie Mae.